You can absolutely do all money out deals in the south, but what you do is you naturally find yourself compromising on something. So whether it's like rental confidence, the area, you go into the peripheries of a certain area, or maybe a slightly dodgy street where actually the purchase price is that much lower. You can still use kind of valuation arbitrage and get a commercial val and, get all your money back out, but you've compromised because you've gone into a housing estate that's got a bad reputation, or maybe you've gone into an area with not such strong rental confidence.
Hey UK property people, we'd love to have you join us at This Property Life Networking. It's a no-guru friendly community. Our network gets a private WhatsApp group for daily advice and deal sharing, monthly online networking with live market updates and in-person events every year. Hit the link in the description below, join today and start building real connections with active property investors. Welcome to This Property Life. I'm your host, Sarah Blaney, and in this episode, I'm joined by Jake Colwill, who's an experienced investor and developer who's built a really smart complementary strategy, flipping properties to fund purchase of high-quality HMOs, which he then keeps. Based in and around affluent areas like Bristol, Jake has developed a formula that balances short-term profits with then the longer-term cash flow. We're going to talk about how he identifies and manages profitable flips, what makes HMOs work in higher value markets, and then how to run those strategies side by side without spreading yourself too thin. So if you're looking to build a sustainable property business that combines the quicker wins with some lasting income, then this conversation is definitely for you. Welcome, Jake, to This Property Life. It's an absolute pleasure to have you here.
Hi, Sarah. Yeah, absolutely. Thanks for having me on.
Every month on the second Saturday, we run an online networking session where you can meet other active investors face to face. And 3 times a year, we bring everyone together at live in-person events. Spaces are always limited, so if you want to be part of it, check out thispropertylife.co.uk/events and secure your spot today.
No problem. Now, you invest with your other half, Lucy, is that correct?
Yes, that's correct. Yeah.
Yeah.
She can't be here today,
Yeah,
sadly,
so-
because of childcare. But it's the two of us that run the business.
Perfect. A lot like myself and my other half, Rick. So it's good, and also it has its sort of challenges, doesn't it, when you're 24/7 doing family work and business all at the same time.
Yeah.
Okay, so I think what we've spoken offline and discussed your business model, and we were talking about what sort of podcast we could do, and obviously I've got HMOs up in the north, you've got HMOs down in the south, and we were like, oh, I wonder if we could do a bit of a playoff between the geographical territories. But actually, it's a little bit simpler than that, really, isn't it? Because you just live in the south and want to invest near home. So to do that, you've worked out this amazing strategy of doing flips, getting the capital and putting it into your long-term holds, because obviously you're faced with a more expensive property to buy, which has its rewards at the end, I'm sure. But that's how you've worked how to do this close to home. Is that right?
Yeah. So for us, I guess it was initially we were looking at kind of what our skill sets were and what we brought to the table, so to speak. What was our kind of competitive advantage in the industry? And actually, I had a background on the tools. So we were kind of very hands-on to start with. The first sort of 6 refurbs we did completely by ourselves. And that was great. But obviously you can't really scale a business doing that because, you just burn yourself out. But once you've then got a portfolio to manage and you can't be sort of on the tools every day as well, kind of doing everything. So it started off with kind of out of necessity, well, not necessity, but that was our kind of skill set. And so we opted to keep everything local. So that we could, be on site, manage the refurbs, all that sort of things. That then obviously comes with the challenge because being in South is great, but the barrier to entry is much higher. So the capital requirements for the deals, are much higher than if you were in the North. So we, out of necessity, really kind of thought, right, well, we need a capital generating strategy to complement our kind of investing so that we can generate chunks of capital to keep acquiring properties. And that it started off very simply. So, when we bought our first flat to live in, Lucy and myself, we renovated it ourselves, we did the work, we sold it, and we made enough to actually go and buy another house to live in. But it gave us a small pot of, a capital that we made on the profit on that. So we went and bought a buy-to-let flat. And we're like, this worked. You do a flip And then, you sell it, and then all of a sudden you've got two properties. And then we flipped the house again and then bought another one. And it just kind of grew like that, really. But it was easy back then, because if you were living there doing the work whilst you were kind of, living in the property, you had lower finance costs, lower stamp duty, all that, all the kind of things that we face now. So when we started doing it professionally and set up a separate business to focus purely on flips, we then had to get a bit more creative with the style of deals that we were doing, because you can't just go on Rightmove, look at a 3-bedroom terraced house and go and compete with owner occupiers, because they don't have the same costs that you do. They're going to be buying on emotion rather than looking at things objectively. So they're probably going to pay more than you'd be willing to pay anyway. Then they don't have bridging costs. They don't have the extra stamp duty, all the things that we have to contend with. So that then forced us down a route of doing some larger and more creative deals. And then as we've kind of grown, those have just got kind of bigger and better, really.
So what sort of capital generating properties do you look at then?
So at the minute, we're kind of focusing on the freehold blocks of flats. So I know obviously you've had James on the podcast who does a lot of the title splitting, but to hold, we're not opposed to selling flats. So, very similar to James, whereby we're buying the block and you get like a wholesale price, and then we're creating the leases, title splitting. We're then renovating each individual flat and then selling them off individually to owner occupiers. And then that's how we would then force our, uplift and get our profit from splitting it and then selling them off individually.
And obviously, yeah, we've had James Lynch on a couple of times on the podcast talking about the freehold title split. And it's an amazing strategy. So you guys are competing down there for the same plots, I'm imagining.
Yeah, we're, I guess so, yeah.
But there's plenty to go around, isn't there? I think there's always an
Absolutely.
abundance, and people don't always buy at the same times. So, all right. So you're looking at the moment at those blocks, and what sort of radius are you going out from where you live? Because I would imagine that that is a smaller pool to fish in. That you're not always going to find those things.
It is, no. So we try and focus on a very small geographic area. So we don't go outside Bristol. So, our build team's here, all of our contacts are here. We end up buying quite a lot off market. So the vendors that we end up buying from, their portfolios are in Bristol. So there's certain vendors that we've bought sort of 3 from already, and they're still sending us more projects. So yeah, we just found it works well to keep it as tight as possible. We've dabbled with properties and, a bit further afield. So in Cardiff, we've got one down in Cornwall. It's just a headache, to be honest. It's just a whole nother build team, a whole nother power team that you've got to establish in that area. If you're sort of actively project managing the refurbs like we are, it's a lot of travel time. So we just decided that we're just going to keep it as tight as possible. And even within Bristol, we'll only proactively target maybe 4 or 5 postcodes. If stuff comes to us, naturally, and it's outside those postcodes, we'll look at it. But really, we're trying to keep it as tight as possible. So we understand the end valuations. We can probably use our own blocks of flats or, flips as comparables. And we had one recently actually where we completed on one block. It was a block of 4 in a certain postcode. We sold the last flat in, I think it was January this year. So we're in November now, so sort of 11 months ago. And in April, we bought another one, which was a stone's throw. It's probably less than a quarter of a mile away. So it was fantastic, because then that was one that we actually held. So we refinanced that into our investment portfolio, but we could use our own properties as comparables for the valuer. So it was great. So that was an all money out deal. It worked fantastically, and we had the confidence to go into that deal because we'd done one so close.
Yeah, it's that whole cookie cutter approach, isn't it? I guess. So, a lot of people would be saying, well, those sorts of projects, those deals aren't sitting on Rightmove, and they're not. You might get lucky and pick up one from Rightmove in a year, but I guess, as you've mentioned, they're off market. So, is there any top tips that you have that listeners and viewers can learn to how to source this type of deal?
So I think it mainly, for us anyway, it mainly comes down to relationships. So the first block that we bought off market, it was actually through an agent, but off market. So the only reason why that came to us is because we'd already sold, I think, 3 or 4 properties through that particular agent. And so we already had a good rapport with them. They then got in touch and said, look, one of our sort of landlords on the letting side is looking to sell this block. Would you be interested in the intro? So they made the intro, and that's how the first deal came about. And then off the back of that, got to know the vendor, and then bought several more after that. Another vendor that we buy from, again, it was kind of like it was my stepdad worked with a guy whose sister had a portfolio in Bristol, and she wanted to
Yeah.
start, liquidating this and sort of reducing the headache that she was sort of facing. So we've bought a couple from her. It all comes from kind of relationships, really. But a lot of those relationships, I think, would be hard to nurture or, kind of establish if you weren't active in the industry, if you weren't there doing the deals in the first place. So the only reason we got that first block through the agent is because we'd already sold, 3 properties through them. And the other 3, they were average deals. They were fine. They made us a bit of money, but it wasn't anything to really, you were never going to leave your day jobs, after doing
Yeah.
those sort of the initial deals. So really it was about being active, having integrity, I think. So, whoever you're dealing with, our view is always actually we want to nurture this relationship because you never know what could come off the back of it, what future opportunities or deals. So, if you're dealing with agents, we'll put an offer in on a property. We never renegotiate, even if something comes up on the survey, we stand by our figures, and then they know that we're a solid buyer. So then they're going to recommend us to future vendors. And on the flip side, if we're selling a property, occasionally things crop up in surveys, and we just say we'll just deal with it. We've got the build team, we'll just jump on it and get it sorted. Whether it's, I don't know, occasionally we've had the odd roof leak during conveyancing or something. So actually we just thought, fine, we'll just put the scaffolding up and we'll just fix it rather than renegotiate on price. We'll just deal with it. So the agents get to trust us as a buyer and a seller, and then they can relay that to the vendors, and then that's what brings us future deals ultimately.
Yeah, and I think that's really important because, I mean, we've said for years between myself and Rick and our wider network that talking to people and relationship building is one of the most important things. This is a people business rather than a bricks and mortar business. And I think if we were to look back on some of our best deals, it's through walking the streets and talking to people that we've picked them up rather than just, sitting behind a desk and scrolling through Rightmove. Now, we've all got to start somewhere, and you might start on that type of a deal, but you've got to sort of trust in that system that the momentum and relationship building will open doors. And it might open a door next week, but it might be 6 months, and to keep at it, I suppose, isn't it?
You just never know, do you? So I think probably our first, I don't know, dozen deals were just on Rightmove. They were just out there
Yeah.
for anybody to buy. And then last year we bought 15, and I think only one of them was on the market. Everything else was off market, and it was repeat vendors, agents. We had one good one through a letter, actually. But even that, it was quite interesting. So that took a long time to nurture. So we sent the letter probably over 2 years prior to actually purchasing this property. And the vendor sat on it for a while. Then eventually he got in touch and said, look, the timing's right now. I'm interested in selling. I've kept your letter. I've been following you on socials. I really like what you do. Can we have a meeting? So then our son was really young at the time. So I think he must have been like a couple of months old. And Lucy and I went to meet him, and with our son in tow in the, in his kind of car seat, and built the rapport with the vendor. And he was like, look, I've had a valuation for an agent. I'm not interested in selling, on the open market. I don't want the hassle. I'd rather sell to you guys. If you can offer us this, it's yours, basically. And so even though it was like kind of an out the blue letter, we still then had to build that relationship off the back of that, got to know the vendor. And then, that was another title split deal. So that was a mixed use block in Bristol. There was 5 flats and a commercial unit in that one.
Yeah. I think, that anyone listening to this, what I'm picking up and what I think that you guys should be picking up is that Jake and Lucy are literally taking a wide range of tactics at the top of the pipeline to try and get all of these deals. They're not just relying on a letting agent or, a vendor that might have a couple more. Jake's already mentioned letters. He's mentioned letting agents. He's mentioned, just general networking. So there's a whole host of little things we can do at the top line of the pipeline that at some point will funnel down into some deals. And as you say, it might take 2 years, but you've got to do all of them, and you've got to be consistent and persistent. That's kind of the message, isn't it?
Absolutely, yeah. We yeah, in a good way, we pester everybody for deals. When we go to see the accountant, we ask, so our accountant's property accountant. So I say, which one of your clients are looking to downsize their portfolio this year? He would know because he's done the tax planning for them. Try to get the intro that way, through agents, anybody that you speak to, really, with a
Yeah.
smile on your face, bit of a cheeky grin, you ask who's selling.
Yeah, I think in another world, Jake, you'd have made an amazing recruitment consultant because it's those 6 points of
Yeah.
interaction and touch points that work. So, all right, so that's how you're finding the capital generating projects, and you are focusing on a certain niche at the moment. So again, I think another key learning from our chat today is know your market really, really well. Jake and Lucy have got a number of postcodes that they look at, and that's the core of their business. That's where they focus a lot of their time, and it then reaps the rewards because they're well known within that little area. That if someone's selling in there, we know someone who's always buying. So it's that kind of, it's coming to you now because you've built that up. But you've done that. So you sold these flats back in January. You get this capital pot. What happens next then? What's the second part of your strategy?
So we have it set up in two separate companies, and then we've got a holding company structure. So once we've generated the profit in one company, we can move it across to our investment business, and that then acts as the deposit for investment properties. So predominantly our investment portfolio is HMOs. We did that consciously because, in our view, they are the best for cash flow. We've got a couple of Airbnbs which arguably are higher returns, but higher maintenance. For us, HMOs offer that, the best balance of sort of profit versus time invested. So the way that the investment portfolio works is we've kind of done this from the very outset, really. So we use our own cash for the deposits, and then we will go and raise private finance, development finance, bridging to fund the difference and the refurb. And then our goal is always refinance on the back end. So we're always running the BRR strategy, refinance on the back end, obviously pay back the bridging lender, pay back any private investors. And we're quite happy to leave our deposit in the deal because we've got a separate strategy that's constantly generating these chunks of capital that we can then just replenish our deposits and keep growing. And that works well because it's difficult to get all money out deals in the south, just because purely the capital values are so much higher. And obviously you need to therefore increase the value by that much more in order to obviously get all your cash back out. But also it means we can go into slightly more premium areas because we can pay that a little bit more for better housing stock in better areas because we can leave cash in. Don't get me wrong, you can absolutely do all money out deals in the south. But what you do is you naturally find yourself compromising on something. So whether it's like rental confidence, the area, you go into the peripheries of a certain area or maybe a slightly dodgy street where actually the purchase price is that much lower. You can still use kind of valuation arbitrage and get a commercial val and, get all your money back out. But you've compromised because you've gone into a housing estate that's got a bad reputation, or maybe you've gone into
Yeah.
an area with not such strong rental confidence. So we don't really want to do that. We'd prefer to invest for the long term and have certainty of longevity and rental confidence and capital growth. So we'd prefer to invest ideally inside the Article 4 in as prime kind of postcodes as we can afford. And so, ultimately, if we have a really good year on the kind of the development and the flip side, we'll naturally go into a slightly more expensive postcode and just buy the best kind of rental properties we can at the time. But yeah, that's kind of how it works, really.
So the properties that you're buying to keep as HMOs, they're obviously of a higher end HMO, which means what, bigger rooms, beautifully decorated, the right postcode, the right location. It attracts a certain type of HMO tenant. But what sort of buildings are they? Are you going for the 4 beds, the 5 beds, or are you going sort of above and into sui generis?
Most of ours are 6, 7s, and 8s. We've got 1, 3, and a 5 bed that we're doing at the minute, that we're renovating at the minute. But yeah, so, ultimately in the south, your purchase prices are much higher. In order to force those values and force the appreciation, to be able to refinance at a sufficient level to get, to repay the bridging lender and your investors, you really need to be adding value. So typically with the HMO model, that's adding bedrooms. So we're doing loft conversions, we're adding bedrooms in the lofts, we're doing extensions to increase communal space and add bedrooms on the ground floor. So, typically we're buying, you get two types of kind of stock really in Bristol. You got your kind of your Victorian kind of traditional sort of bay fronted properties with the outrigger. They work really well. Or you've got your 1930s style. They're squarer, they're wider, they're not quite as deep. They don't have the outrigger. They both work perfectly well for HMO conversions. The majority of our stock's the Victorian style. We just prefer it. We love the period features. We love the character. And naturally you find the sort of more prime areas are kind of, it's Victorian, or it's period properties, because they're a bit more central and they're around all the kind of, universities or city centre. And then the
Yeah.
1930s stock is kind of on the peripheries and a bit further out of town. So we prefer the Victorian stuff really.
And when you're looking at these properties, though, obviously this is an Article 4, a lot of Bristol, where you're talking, is an Article 4 area. So you're having to get planning on these.
Yeah. So if we're inside the Article 4, we're typically buying existing HMOs. So we'll be
Okay.
buying small HMOs. We'll be buying 3 beds, 4 beds, 5 beds. Obviously, we're getting the established use. So we're getting a certificate of lawful use for C4, taking up to 6 beds under PD. And then in most instances, we're going from 6 to 7 or 6 to 8 via a full planning application, with our fallback always being we can make it a 6 anyway.
Yeah. So if the numbers work at the C4 level, then great. But the intention is then to take it from C4 through to 3 generous, with development up into the loft and out into
A-
the
Absolutely.
garden, etc.
Because we're working,
Yeah.
with private investors, we can't be reliant on the sui generis, or the 7 or the 8 beds. So it has to work as a 6 as a minimum. And as long as it works as a 6, we're comfortable going into the deal. And then, if we get the sui generis use and we get the extra couple of bedrooms, then that's just the icing on top, really.
So I think one question that people that invest up in the north might have at this point is, well, up in the north, if I was to do a 6, a 7, or an 8 sui generous property, it's going to get commercially valued, and that's probably the way I want it to be. Obviously, we never want bricks and mortar and commercial to be so out of kilter with each other that if you go to sell, it's kind of like you're in no man's land. But down in the areas that you work in, how do your valuations work? I mean, are you actually at a bricks and mortar and the commercial might be less?
Yeah, so we had a really interesting situation this year, actually, which might be interesting for the listeners. So we bought a block of flats. There were 7 flats, and then one. It was like a freehold house in on the back, and the house was a 4-bedroom HMO. So when we bought the block, it was on one freehold title. So it got valued commercially, so based on the rent roll and a yield, and they applied a yield based valuation to the HMO, and that kicked out a valuation of 420,000 for this 4-bedroom HMO. But actually, we were looking at it going, well, no, that doesn't really make sense, because the bricks and mortar valuations in this area for all the residential houses is kind of 600. So when we then split the titles and we came to refinance that block, we said, no, we don't want a commercial valuation. We want to go with a lender who's going to instruct a bricks and mortar valuation. So we did, and the valuation came back to 575. So it's like 55k uplift by knowing which valuation was going to work out better. And so I think going back to knowing your area, it's so important. We have, quite a few HMOs in areas where the commercial valuation would be lower or comparable to the bricks and mortar valuations. Well, in that instance, you're better off to go to a cheaper lender, because ultimately lenders who are valuing, bricks and mortar, they're perceiving themselves to be taking less risk. They're offering a lower rate. Also, the valuations are cheaper. You're paying maybe 400 or 500 quid for a valuation rather than 3.5 grand. So there's a lot of sense in going with a bricks and mortar valuation if it stacks up, which, again, going back to my sort of analogy, if you're going into those periphery areas or slightly cheaper purchase prices in Bristol, you go for the commercial valuation because you're going to get a higher valuation on the back end. If you're in the more prime areas, then bricks and mortar valuation is probably going to be better for you.
Yeah. So your intention is that you're going to hold these for how long? I mean, have you got an idea yet? Because obviously an HMO, when you first done it, that's the best it's ever going to look.
Yeah.
It looks absolutely wonderful. And then people move in and create a home there. And obviously there's wear and tear and, you know, it starts to need a bit of decoration in like maybe 5-6 years time. So what's the strategy there, Jake? Are you keeping or are you then going to sell on?
So whenever we buy any investment property, our intention is always to hold it indefinitely. We're in our early 30s, so who knows? You know, when we're in our 50s, we might be sick to the back teeth of HMOs. But at the minute, it's to hold everything. However, we do review the portfolio pretty much on a yearly basis, and we had some like individual buy-to-lets where, you know, we got all of our initial capital back out, but we were looking at it going, well, actually, the return on equity on these deals is really, really poor. So maybe it's sort of low single-digit return on equity, whereas we know that we could crystallize that equity, sell the property, and then redeploy the funds elsewhere. So we are always reviewing, you know, all of our deals just to make sure they're still performing. But yeah, the goal is to hold everything really. So, you know, when we're buying these properties, we're going really heavy on the capital expenditure. So pretty much everything's back to brick, rewired, full new plumbing system, insulated, you know, through the roof. You know, quite a lot of them have got solar panels. If they don't have solar panels, they've got the infrastructure. So they've got the first fix and all the cabling to install solar panels in the future. So everything's really an EPC C, but if we needed to, we could plug in solars and make everything a B. So, you know, we've spent a lot from the outset to make these things future-proof. The maintenance isn't too bad. So like with our student stock, we are very proactive. We will give everything a refresh in the summer between sort of, you know, students moving in and out. The professional stock and the professional rooms will typically be going in between, you know, room changeovers and redecorating, occasionally changing carpet. So our model is to kind of slowly and steadily just continue the upkeep of the properties to try and maintain that kind of new feel and also the premium rents that we achieve. As opposed to obviously, you know, you can save cost and increase your kind of monthly P&L if you don't do that, but then you're going to get hit with a bigger lump sum for maintenance, you know, in 2, 3, 4, 5 years time, whenever you actually bite the bullet and do it. And then it's much harder to manage with tenants in situ. Little refurbs you can do with tenants in situ without then losing any rent, which we prefer.
Yeah, absolutely. I think another thing that I'm picking up, and hopefully others are too, is that you have a really strong strategy, and you look at this as a very, you know, you're doing it as a professional business. So you're looking at everything from a business perspective. So you mentioned return on equity and reviewing portfolios. I think this is something that a lot of people might fall down on when they go into property investing. They kind of put so much focus into the buy-in and the refurb at that front end, and then they just leave it. Whereas you've got a very strong strategy and you know exactly what you're doing. And, you know, that I think helps in terms of probably getting investors on board because you're very, you know, transparent on what you're up to, but also just having that cookie cutter approach because once you've done it once, you can do it again and you're more efficient the second time and the third time, the fourth time. And then you've created your own little market where you are having comparables. So you're probably doing that in your HMO market as well, in terms of the comparables, sometimes of your own properties.
100%. Yeah, the first time you do anything is the hardest, right? You don't know what you don't know. So, you know, the first commercial to resi conversion we did was painful. The first block of flats was painful. The first HMO was painful, but then it just gets easier and easier over time to the point where you don't really think about it so much. It's just a rinse and repeat. Like you say, we can use our own comparables. We know the end valuations. We know the valuer that we're going to pick before we've even bought the deal. You know, we know what rents we're going to get. Quite often, we've actually sometimes got tenants lined up to move into the property before we've even finished the refurb because where some of our professional HMO tenants moved out, went and lived elsewhere, they didn't get on with their new landlord. So they've come back to us and said, have you got any other properties? And so you can say, well, actually, this is in the pipeline. It'll be ready in 2 months, 3 months. And so we filled rooms before it's even finished.
Yeah, I think that sometimes that economies of scale works really well. You know, when we had an awful lot of student HMOs up in Merseyside, and you would get a lot of referrals from your current tenants as to, you know, new batches coming in, or, you know, they'd stay with you for 2 or 3 years and then they'd go, yeah, no, of course we'll put up some notices for you. Of course we'll, you know, post on this group and that group for you. And it builds momentum, doesn't it? And you only get that by niching and knowing your strategy.
Yeah, absolutely correct. Yeah.
Amazing. So hopefully people have got some really good ideas of how actually investing in areas where the property prices are a lot higher can work by either complementary strategies, just knowing your shit really, really, really well, and having that focus on the strategy and the area. So I think, you've given some really good insights into how to make it work. And things that I think people need to pick up on is the wide pipeline at the top. You guys are doing lots and lots of different things at that top line to get those deals, whether it's the flips, the multi-use blocks, or whether it is the HMOs as well. But yeah, I think it's pretty inspirational at this point because everyone's kind of like a bit worried about cost of living, what Reeves is going to do in the budget, and it's might air after the budget, and we'll all know how screwed we are. But I think you've got a strong vision. You're investing in the long term, and it's proven dividends for you at the moment, isn't it?
Yeah, I think there's a lot of negativity around at the minute, but for those investors and developers that are brave enough to capitalize on it, this is when the best deals are done. So, we established our business in 2018, and yeah, pretty much every year there's some sort of disaster or catastrophe in the media. So, obviously, we had Brexit, the Brexit vote, and then actually Brexit happened. And then we've had COVID, and we've had the cost of living crisis, then we've had interest rates go through the roof, and now we've got the Labour government hammering landlords, and now we've got the Renters' Rights Bill coming in, and then another budget coming up in a month's time. And some of the best deals that we've done have always been around those events. And actually, it's never transpired to be as negative as everyone thinks it's going to be. But we've had, we've bought quite a lot of sort of ex-rental stock from landlords that maybe have got one or two, and they just thought, it's not worth it anymore. It's not worth it dealing with the Renters' Rights Bill or the extra tax changes or whatever it is. So we've just thought, okay, well, we'll buy these. We will kind of de-risk our portfolio through scale. If we have some slightly more bad debt, tenants not paying their rent, or we have to, pay extra for, the regulatory sort of burden that we're kind of facing at the minute, we can absorb that through scale and just growing through it. Whereas if you've got one or two, you've kind of got a decision to make, right?
You're vulnerable, aren't you?
100%. If you've got one buy-to-let property and the tenant stops paying rent, you've still got to cover that mortgage. That's an issue. You're potentially subsidizing it out of your salary. If you've got a portfolio that's a certain size, you can absorb it, the others cover it. You just have to factor it into the costs and then just kind of plow through it, really.
Yeah, amazing. So I think you're right. I think scale is the thing. If you are one of those landlords that is at one or two and you're not sure which way to go, don't stick where you are because as we've discussed, it's a vulnerable situation. If the boiler goes or if your tenant does stop paying rent, you're in a very precarious situation. Whereas if you have 10 behind you, 10 other rentals behind you, they can absorb that cost. Or you might decide, actually, I'm exiting the market. I'm going to go and spend that money on a different type of asset vehicle. And if you are doing that, then Jake and I would love to hear from you.
But one or two,
But
you've done the hard bit, right? You figured out the area, you found the strategy. Hopefully they work for you financially. That was the hard bit. You've proven the model, and now it's just about sort of scaling it, systemizing it, rinsing and repeating. Maybe work with some private funders. Maybe just improve slightly to make the deals work that a little bit harder for you to make your money go a bit further. The first few, the hard bit, and then it gets easier after there. So. Yeah, I'm
yeah,
advocate for scaling, but obviously everyone's kind of risk appetite and financial situation is different, right? So everyone's got different goals, and everyone wants, a different result out of this. So it depends kind of what you're trying to achieve.
yeah, that's it. It is very much goal driven. But yeah, let the negativity of the press, don't let it put you off things because that's what they do. That's their job. It's our job to circumnavigate that and just keep going. So thank you, Jake, so much. I've had some really wonderful insights as to how you guys run your business, strategy, complementary strategies, and niching down is some of the key things that I've taken from our chat today. And hopefully others, will look at their own sort of business at the moment and think, yeah, actually, this is kind of, my niche. This is what my strengths are, and they can take something from that. So thank you so much.
No worries. Great to chat, and thanks for having me on.